What's up guys, Jake here. In this video, let's cover the hot issue of the Chinese stocks. There are large companies like Tencent, Baidu, and Didi whose share prices are down huge so far this year. However, the one Chinese stock that has me the most excited is Alibaba. Often referred to as the Amazon of China, it's an e-commerce giant that's growing very rapidly. They're also involved in healthcare, entertainment, cloud computing, huge revenue growth potential for this company. And in my opinion, diversification of Chinese stocks has no purpose. The risk to all of them is the same right now, so if you're going to invest in Chinese stocks, you might as well pick the best one. In this video, let's cover should you be buying Alibaba stock, then when is the best time to buy Alibaba stock, and then finally, how should you be buying Alibaba? You have several options. We'll cover them at the end of the video. If you guys like this kind of content, give me a thumbs up so the algorithm knows it's good, and consider subscribing to my channel if you haven't already. I'm sure if you're watching this video, you've already heard of Alibaba and you know how great of a company they are, but let me just break down once again the financials for you. We're on macrotrends.net looking at their revenue growth quarter over quarter. And last quarter, Alibaba did $31 billion in revenue, which is a 46% increase year over year, so 4 quarters ago. The previous quarter, they had done $30 billion in revenue, which was a 101% increase year over year from March 2020. Obviously, that was a little bit down because of the pandemic. But just look at the revenue growth of this company over the last 5 years. They've basically 10x'd their revenue growth in 5 years. So it's logical to think that their share price should 10x in that time as well. And the projections going forward for this company as they continue to expand operations across Asia and the world, this is a very promising company. You can look no further than basically the price ratios to see what this company is currently being valued at, their share price. When we look at P to E, it's currently 19. However, in 2016, 2017, the P to E of this company, a rapidly growing company, it was valued at 51. So it's currently only 19, and this company in the past has been valued at 51, meaning the current share price of this company could easily be 2.5 times higher than it is today. We can go ahead and also look at price to sales, and you can compare it to other fast-growing tech companies like Amazon or whatever. And their price to sales is only 3.74 right now, whereas in the past, this has been as high as 15. So according to price to sales, you could justify quintupling the current share price of Alibaba and having it still make sense. When we look at price to free cash flow, this is the best one. Once again, lower numbers is always better. And their price to free cash flow is only 13 right now. And in the past, this has been consistently valued in the 20 to 30 range. Now, when it comes to Chinese stocks, you definitely want to be cautious of their accounting practices and their reported numbers because China has a notorious history of fraud and cooking the books. However, there are billionaires, large investors, way more experienced and smarter than me. A good example being Charlie Munger, the vice chairman of Berkshire Hathaway, who has personally done the work and investigated these numbers, and he says that Alibaba's numbers are legit. Therefore, I'm going to give Alibaba the stamp of approval and say, if it's good enough for large investors like Charlie Munger, I'll trust the numbers as well. So what's the problem with Chinese stocks right now? What's the problem with Alibaba? And there are 3 problems. The first one is right now the US government is very hostile towards Chinese stocks as far as regulation goes, and there's a risk of delisting. Number 2 is the Chinese government is hostile against their own Chinese companies. Once again, more regulation and crackdowns on basically just becoming monopolies and getting out of control. And then the third one is these listed stocks are not actually shares in the equity of the company. They're stocks for shares in a shell company in the Cayman Islands. And this fact alone has enough people weirded out that they don't feel comfortable investing in these Chinese stocks. Let's address these 3 issues. So the first risk is the American Security and Exchange Commission basically imposing new regulations to Chinese companies saying, hey, if you want to be listed on the New York Stock Exchange, you have to follow our fair accounting and reporting practices. All the American companies have to abide by these rules when they report their numbers. Chinese stocks, at the same intervals, the same practices have to do it as well. So there is no risk on the American side of a blanket all Chinese stocks are going to get delisted. It's just the Chinese stocks that refuse to cooperate with this new regulation. And the SEC has given them 3 years to comply. So a company as large as Alibaba, I don't see them being a risk because I don't think Alibaba is trying to defraud investors or scam anyone. It's a legit company. However, there are other Chinese companies and Chinese stocks doing IPOs and SPACs who I don't believe any of their numbers are real. So those are the companies that are at risk of being delisting. So on the American side, no, I don't think the SEC is going to delist Alibaba. The second issue is the Communist Party government of China being hostile towards their own corporations. And this has been going on for a while now, but what has been affecting Alibaba goes back to December, January, when the founder of Alibaba and potentially the richest man in China, Jack Ma, just started criticizing regulators, criticizing his own government. And perhaps he thought he was rich enough and powerful enough that he thought he could get away with it. And I don't think the Communist Party government in China is going to let, a private citizen, it doesn't matter if he's the richest man in China, they basically removed him from the company, put him under house arrest. He's still alive, but they're not letting him do public interviews or speak out. He's basically under house arrest until he learns his lesson. So for high-profile individuals critical of their government, they definitely are at risk, but the companies themselves, I don't think China wants to do anything to hinder or hurt them. China has been running this great experiment the last 50 years where they basically embraced capitalism. They had been trying state-run communism after the Communist Revolution for 20, 30 years. It wasn't working. And they were looking at the prosperity of places like Singapore, Hong Kong, Taiwan, and in the 1970s, they basically said screw it, and they embraced free market capitalism. However, they took the best parts of Adam Smith's Wealth of Nations, but they said no free speech, and we have final say over everything. However, private investment is allowed, and people are allowed to get rich. This is what led to China's great success story. They've lifted something like 900 million people out of poverty in the last 50 years, and they're not idiots, and they know what has caused their success, and having these companies flourish and succeed in a global marketplace, they know how important this is. However, single individuals like Jack Ma, they're not going to give them a free pass. So China is not a true free market capitalist society. It is something called state-run capitalism, where the communist government owns the capitalist system operating under their jurisdiction. So capitalism is okay as long as the communists are still in control of it. And the headlines coming out of China that has everyone freaked out, for example, is the nationalization of the after-school programs. Basically, if you're not familiar with this system, kids go to public school for 8-9 hours a day. They then leave public school and immediately go to private schools and after schools. And I think this decision by the Chinese government is actually popular with parents because the more money you have, the better after-school tutoring that you can afford for your children. Your children then have an advantage over their peers for test taking and getting into the best universities, which leads to the best jobs. So in Asian culture, there's just this overheating of the education sector, something that in America we're not very well experiencing. I lived in South Korea for 6 years. It's called the Hagwon system over there. I don't know what it's called in China, but I imagine it's probably worse than it is in South Korea. So the fact that the Chinese government basically converted all of these after-school programs into non-profits. They are not allowed to make a profit anymore. I think this is actually popular in China, but I don't think this has a ripple effect where it's going to affect larger companies like Alibaba. This is an isolated sector that was causing a lot of problems for Chinese families, and the Chinese Communist government solved it. Now, there are private investors who owned or were invested in these private school companies that basically just, F you lose everything. But that's just how it is in China. Is this going to affect companies like Alibaba? Once again, I don't think so. Other news coming out of China that has American investors cautious, for example, is China plans to ban US IPOs for data-heavy tech firms. This is happening both ways right now between America and China. America was being very critical of TikTok for a Chinese company having access to American user data. So when Chinese companies like Didi, which is the Uber of China, lists their app in America, potentially the American government could have access to Chinese citizen user data. So China planning to ban future IPOs, they're just trying to be protective of their citizens. Does this affect companies that are already listed like Alibaba? I don't think so. I think that China and America will find a way to resolve this where each of their citizens, their citizens' data are protected and privated from each other's governments. So while the Chinese government is being hostile towards their own companies, I don't see them doing anything that would hurt their GDP growth or their economic prosperity. They know exactly what has made them successful over the last 50 years, and I don't see them disrupting the operations of a very successful company that's very popular amongst their citizens like Alibaba. So let's go to the third problem of Alibaba, which is that it's not actually the equity in the company that you're purchasing. The true shares of Alibaba are listed on the Hong Kong Stock Exchange. So when you go on the New York Stock Exchange and buy shares of Alibaba, you're actually buying shares of a company in the Cayman Islands that has an agreement with Alibaba. And this is called a variable interest entity. And all the Chinese stocks and lots of other foreign stocks are doing this, but this is just a legal structure for people in America to go on the New York Stock Exchange and invest in international stocks. I think because the share price of Alibaba has gone down so much, people are just looking for any excuse to be critical of it and be cautious of buying it. Nobody was being critical of the VIE structure when Alibaba was at $3.20 a share. So I don't see this legal structure or entity being challenged in any legitimate way. If it was good enough 2 or 3 years ago, why is it no longer any good? Yes, it seems kind of odd. However, if the largest investors in the world, true billionaires who are buying shares of Alibaba through a VIE, once again, if it's good enough for them, it's good enough for me. I don't see the people involved in Alibaba who made this agreement with the people in the Cayman Islands, basically destroying or delisting and evaporating $400 billion worth of shareholder equity. I mean, that would be the biggest scandal or crime of the century. It's just not going to happen, guys. So when it comes to Alibaba stock, I don't see US regulators forcing it to delist. I don't see the Chinese government forcing it to delist. And I don't see the legal entity of the VIE changing in any significant way anytime soon. So there's definitely still risk involved with these Chinese stocks, but I personally do feel comfortable buying Alibaba stock. So the question now is, when do you buy it? And I definitely think for Alibaba stock, this is a pure technical play right now. If we go back to when Alibaba stock peaked, it peaked on October 27th. Around this time, this is when Jack Ma was disappeared by the government and nobody heard from him for a couple months. In January, he resurfaced and it looked like the stock was going to recover. We then started getting all these rumblings about the Chinese communist government cracking down on their corporations. So this is pure technicals, guys. Look at the share price as of November. It fell below the 20-day moving average. It then looked like it was going to stabilize. All the moving averages started converging. It then fell back below the 20-day moving average, and it's been stuck in a downtrend for 8 or 9 months. Let's zoom in to the 6-month chart here. And once again, it can't significantly stay above its 20-day moving average. In July, it bounced off of it. July 22nd bounced off of it. Let's go ahead and zoom in on the 3 months. So currently filming as of today, the share price, it's up 4%. It's at 173, but it is still below that 20-day moving average. And I easily could see it being rejected again because we haven't gotten the all clear or positive news from China. So when is the best time to buy it? Well, this is a falling knife, guys. And if it's falling, don't try and catch it. You're not going to miss your opportunity to buy this stock before it shoots up 10, 20, 30, 100%. It's going to be very obvious when this stock is back in an uptrend, but that's probably not going to happen until this 200-day moving average comes down farther. There are just large investors, large funds that are not going to pour money into a large cap stock. You know, the market cap of this is $400, $500 billion. So these moving averages need to come down, and the share price has to stabilize. It has to stop falling, which there's no evidence that it has yet. This could easily fall below 150. It could go as low as 100. There's no reason why it can't keep going down. But what we need is more time for these moving averages to converge, and then that will signal, assuming more favorable news coming out of China, it'll signal that this is ready to go back into an uptrend. And where is the upside potential for this stock, guys? I mean, once again, it peaked at 309 here. This stock will probably recover soon and recover fast once, you know, news conditions become more favorable. So the final thing to consider is, how do you want to buy Alibaba? If you want to just buy the stock, then potentially in the next couple years, it could get back to all-time highs. Over the next 10 years, the share price of this company could easily 3x, 4x, 5x, 6x, given their tremendous growth. However, if the risk of of buying Alibaba stock is not their fundamentals, if the risk is it could get delisted, or the shell company could collapse, or the share price could go to zero. If the only risk you have here is not downside share price movement, but it going to zero because the company gets delisted, then you might as well buy options on it. The risk of buying options is the option expires worthless. The value of the contract goes to zero. So if the risk is the stock price could go to zero if you buy shares, and the risk is buying options, the contract value could go to zero, then you might as well just buy options. And I think the safest play is to buy a call at the furthest out expiration. So let's go to, let's see here, let's go to June 16th of 2023. This is 653 days, so almost 2 years. And we're going to look at just the calls. And if you want to buy an at-the-money call, that's going to be more expensive, but you know, you'll immediately start gaining intrinsic value. But if you want to, once again, risk as little money as possible for a maximum gain, then go with an out-of-the-money strike price. So this stock got as high as 317. So let's look at the 300 strike for June of 2023 on Alibaba. Here's the option chain. We're going to scroll down, scroll down, scroll down, and here it is. So for the strike of 300, option interest is 32. Buyers are bidding 975. Sellers are asking 1040. So if you want to pay about $1,000, you can buy a call contract on Alibaba. And where could it go if Alibaba over the next year or two recovers back to 300? I mean, this could easily, let's look at where the value is. It could easily 4 or 5x. There actually isn't as much option interest as I thought there would be. Let's look at the expiration date for January. I bet there's more in January. So if we go for a strike of 300, here we go. There are lots of other people having the exact same idea I have. Option interest 21,000, volume 143. Oh, this is much cheaper actually. So for about $675, you can get a long-term call contract with a strike of 300. So how do you make money on this? If you hold it until expiration, January of 2023, your break-even price is 306.55. So Alibaba has to get above 306.55 by January of 2023, which is a year and a half, for you to make money. But if it recovers fast, like in the next 6 months, gets back up to 300, I would just unload the contract and take the profit. But of course, if you don't want to mess around with long-term call contracts, just go ahead and buy the stock. If your goal is to buy and hold it for a period of like 10 years, you have a really good chance of a high return because the growth potential of this company in Asia is tremendous. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.